Let me paint a picture for you. It's a Monday, you're lying on a beach, and the only thing that you're worried about is where to grab lunch and dinner. You've got your favorite beverage in your hand, and maybe it's even a pina colada. And you know what? You can choose to do this for another month without someone telling you to get back to work. Sounds impossible? And yet, it is possible. In this scenario, you've achieved what many, many people are dreaming of. You're financially independent and have retired early, and that is called FIRE. Of course, I failed to mention the age at which you're doing this. Here's assuming that you're maybe in your 40s or even in your late 30s if you're lucky. Today's episode is going to go into how you can achieve this elusive target. Joining me on the show is Santosh Joseph of Germinate Investor Services. Santosh, thanks so much for taking the time.
Hi Alex, glad to be back.
Are you dreaming of FIRE?
Oh, I'd love to. In fact, when you were painting that picture, I was wishing it was me.
Doesn't everybody
and it doesn't matter whether it's the beach or the mountains, as long as it's that kind of a format.
And so everybody that I've spoken to, irrespective of what they're doing, they're enamored by this idea of not having to, and especially those people that are in 9 to 5s and or maybe 9-10 hour work days, they don't want to do it anymore. At least they want to have the option to not do it anymore.
Correct. So I think increasingly people are realizing that they want a good work-life balance, and because they're not able to achieve it at work, they have to make the segregation that when I'm working, I'm going to slog it out, so that when I retire, I can, live the picture that you just beautifully painted for us. That is that I can chill out, not be worried about the stuff that would normally worry me, but worry about mundane things like where do I get my meal from or where do I go for a walk for. So this is the kind of dreams and aspirations that we have, and it's getting more pronounced today that people want to enjoy life. There was a time where it was about career, it's about money, it's about meeting certain milestones or bucket lists. Today, FIRE is a bucket list.
FIRE is a goal. Even this week I spoke to somebody who was aiming to do this 34-year-old gentleman who wanted to do this in 11 years' time. But some of the numbers were a little startling to him. And so the advice that he got from one of the experts like yourself was that he might have to work till he's 55 or 57, and only then would that be achievable. This formula, how does it work?
See, the general thumb rule for the FIRE is that you have about 25x. Now, what is this 25x? That you don't retire till you at least have 25 times of your annual expenses that you need. Now, let's actually break this down. Assuming you need ₹1 lakh a month, which translates to 12 lakhs. You have to multiply 12 into 25, that would be over 3 crores. That's the kind of money that you need to be able to retire today. So that at retirement, you live off on a small portion of the income that this money can generate, so that you don't have to work and you can live that dream that you're just dreaming today while you're working.
So, but what is incongruous to me, and what sometimes may be a bit of a fly in the ointment, if you can call it that, is that this 1 lakh rupees is all well and good. But you see these inflation calculators and they're very scary. They're talking about what your expenses are going to be in 20 years, and it's some obscene number that you can't even imagine how you're going to spend that much money. It doesn't add up, does it, Santosh?
Absolutely. See, for starters, the expense that we are going through today for our lifestyle expenses is way greater than what one imagined 20 years ago. I mean, 20 years ago, when we had so much of lesser lifestyle, many of us, especially the generation of our parents and maybe even for us when we started our careers, was very simple, life was very easy. But today, thanks to all the consumerism that we have, costs have gone up, and more so voluntarily. Now, we know when we retire, we don't want to cut corners, but we want to enjoy that retirement time. So therefore, it's one, the need for more spending capacity, and two, the cost at which this is going to come, especially when it's 20, 25, 30 years from now. Even a small percentage rate of change of inflation will have a very significant impact of how much money you need. Therefore, for any successful FIRE establishment, that is your being ready to retire early, it begins by number one, planning early. And I think the previous example that you gave, when someone did this assessment and they realized that do not retire now, wait till 55 till you retire, is good advice. Because how do you solve it? Either you accumulate more and hope that your accumulation plus the growth helps you achieve that number, or continue to work longer. Just tell yourself you're not ready yet, right? Ready yet to be able to afford the lifestyle that you want to. Therefore, plan a lot more, save a lot more, and hope even the savings also grow well. What most people calculate is how much my money can grow. But the key vital ingredient is how much are you putting aside to the goal.
Okay, how much are you contributing? So therefore, FIRE is, yes, it is a goal, but it is not a final destination in that sense. It is a question. Are you ready to retire? And sometimes the answer is no.
So the interesting part is all of us, thanks to the beautiful picture that you painted, want it.
Yes.
And maybe we convert that goal into very actionable steps and we are disciplined to do that. The big question is, when it comes to the point where maybe you're FIRE ready, are you willing to then take the plunge and enjoy it?
Are you mentally ready?
Yeah, mentally ready. Because see, it's one thing to work hard. It's another thing to be disciplined to save and wait for 20, 25 years. Because if you worked hard and if you've been prudent and disciplined to save and spend that, save and grow that money, I don't know whether you have the mental capacity to enjoy it. I think that's the realization we are having as the Indian investor and population, that we may be great in working hard and saving. We're not that great in enjoying that benefit.
That's a good point that you make, because ultimately it's been described perhaps as the dog that is chasing the car, and when it catches the car, it does not know what to do with it.
Absolutely. I think you said it well.
And so therefore, you're talking about a situation where you don't know what you are going to do with the time that you have on your hands, right? I talk about my own dad.
Yeah, it's like this. It's what ticks in your mind.
Yeah.
If you're disciplined to follow a target, if you're disciplined to save, it's going against the grain to actually spend that money.
Yeah.
Now you want to let it continue to grow even more, because also don't forget, when you save for 20, 30 years, you begin to see the power of compounding on your money. The little that you saved has become exponentially greater. See, the power of compounding is only rewarding for the people who are at it for a long period of time. And when you've seen the benefit, you want to let it grow even longer. That prohibits you from enjoying it.
So let's then classify this. And I know that this is a concept that a lot of people have spoken about. Ultimately, then, FIRE should allow you to say at some point of time, I don't want to do this anymore, but it's an option. It's a choice that you have available to you, and you work towards having that choice. Is that fair?
Number one, it's a choice. Number two, it's a decision even before the choice that you have to make, that, I want to be ready. Now, the choice that we spoke about would be beautiful, that when you're financially ready to retire early, but you decide to prolong it, and that's a sweet spot.
Yeah.
It's like you got all the money, you can be enjoying the luxuries of saving the money, but yet you got the physical stamina and energy to work a little more. I think that is a great spot to be, because on one hand, you're working hard because you have no choice. On the other hand, you're continuing to work even though you don't need to work. I mean, you're talking a different realm there.
And your mindset changes.
Absolutely.
There's nobody who's going to be able to bully you at work, by the way.
Well, some of us self-bully ourselves with the commitments that we make. It could be as simple as your home loan, is your living expenses, your lifestyle expenses. Sometimes there is external pressure. Sometimes there is pressure that we've taken it upon ourselves with the lifestyles that we need.
Can you be at a FIRE stage without having your own house?
You can, but remember, one of the effective ways to be financially independent and to be able to retire early is to have literally zero liabilities, one. Number two, ensure that your lifestyle is largely sorted. So therefore, when you have your own home, where there's no rent to pay and there's no more leftover payments to make, or you know that this is a secure asset of significant net worth in itself, actually plays into the FIRE. So is there a hard and fast rule that you should not be in debt even at towards the end of FIRE? No, but it makes great sense to be absolutely liability free and to have assets, not only financial but also physical. So therefore, home is an asset which is not financial but physical, which also helps you build net worth and liability-free, stress-free living.
Okay, to talk about this generation of capital that you absolutely need, it's only possible, I would think, using growth assets. But how do you go about doing this? Everybody says start early. Would you say that you're in an incredibly good position if you achieve a certain landmark within a certain time frame, and I'm talking about amassing a certain amount of money. Incidentally, we did talk about building your first crore on this very program, and I thought that was a fascinating conversation because that's the first real major hurdle that you need to overcome when you're building wealth, right?
So the benefit for many of our viewers watching this is that while you're working towards FIRE, we largely ignored the ability of growth assets
Yes.
playing the play. We know it's important for us to save. Basically, we're accumulating the money. The second half is the value that it produces through growth assets. But before that, we spoke about starting early. I mean, it's the most underrated aspect of FIRE that the sooner you start, the better it is. In fact, from the first paycheck, if you set the ball in motion, it's good. And therefore, when you start from the first paycheck in your late 20s to early 30s, if you have a milestone, for example, whether it's 50 lakh or a 1 crore or more than 1 crore, you know, you overcome a psychological barrier. We all know, and we've said this, the first 1 crore is always difficult. The second 1 crore is not difficult. And therefore, the first 10 crore is a mountain of a goal. But after 10 crores you've achieved, and then when you talk about the power of compounding, you'll start adding crores easily, and the 10 becomes 20, 30.
So for people that missed that episode and who want to understand whether it's actually possible, would you say that they would be in a fantastic position if they achieve that 1 crore before 35?
Before 35, and for some of you are going to be a little more slower depending on your career or even the propensity to save. Even 40 is a great number, because even at 40, if you've got a crore of savings, right, that puts you into the top maybe less than 1% of the country with a saving net worth of a crore.
So I know that a lot of people look at these calculations and look at these projections and they scoff at it. Right? They're unbelieving practically, right? But you're the numbers guy, so why don't you lay it out and say, how is this actually possible? Because, and I know that you're going to talk about 12%, and a lot of people will say, why 12%, where we've grown at 18, 19% over the last 4 or 5 years, but then we'll get to that as well. But at 12%, how long would it take for me to achieve that number?
There is a nice indication on your rear view mirrors when you drive the car that objects in the mirror appear closer than they actually are. In fact, that's the reality of our financial planning. They're actually closer, but we're not able to make right judgment to it. And therefore, the standard way that we respond to that is saying, please start early. Be a lot more disciplined even if you don't feel up to it. Now comes to the numbers. See, the numbers are simple. Now, for the people who don't like numbers, it feels a little daunting, but they're actually simple. So I took a simple number of even a 25,000 rupees saving every month, and assuming you started 30, not in your early 20s, some people miss the bus, but I'm repeating again.
And for some people, I know, miss the bus, and some people just can't, Santosh.
Even if you started 30,
a
25,000 rupee investment into 12 is about 3 lakhs a year. For 10 years, it is 30 lakhs. For 20 years, it is 60 lakh. And for 30 years, it is 90 lakhs. Taking 12%. Now, how do I arrive at 12%? I'm just taking a longer term, lower average of what our larger benchmark index has done over 10 and 20 years.
Nifty 50.
Now take Nifty 50. For the last 10 years, it's averaged slightly more than 13-14%. Even on a 20-year basis, the number is between 13.5 to 14.5%. Now, you know, Nifty is far more rewarding to you than the world's greatest investor, Warren Buffett.
Yes.
Right? Which means you have something that is favorably going for you, that by being a simple, passive investing for dummies, you're able to make a lot more of your money than what you save. Now, what happens to that 90 lakhs?
But before you get to that, just to drive home the point, even if you're not looking at Nifty 50, just look at nominal GDP growth, which is how much your economy is essentially growing. You're talking about real GDP growth plus inflation, right? Which is what everybody looks at. And you're adding a couple of percentage points over that.
For their market efficiency.
So that the companies that you're investing in are perhaps growing faster than the country as a whole is growing. And so you're expecting 12%. And that's a fair estimate.
Absolutely fair. Because see, you take at any given point, over long periods of time, 5 to 6% inflation is normal. Especially for a developing economy like India, you're bound to experience at a retail ground level a 5 to 6% inflation. right? And at the growth level, I think we should continue to be at that 5 to 6%. I'm sure the policymakers and the government will want much higher growth. But 12 is not a big
And
ask.
durable is 6 to 7%,
Yes.
whatever, for a country
So
like us.
the 12 is not a far-fetched number.
Yes.
It's a slightly lower of the long-term averages of what the markets have delivered.
12% is achievable. Let's come back to our example. You talked about 25,000 per month, 3 lakh per year.
So that's about 90 lakh over a 30-year period.
Yes.
Now, let's be practical that nobody's going to save only 25,000 when you're in your 30 and stick to that number. As you progress in your career and your income level, you're going to, of course, save a lot more, at least keeping in line with the amount of money that you earn. But for this hypothesis, we'll just stick to 90 lakhs saved over a 30-year period. But the resultant being well over 15 crores is the big bonus for you there. So in the pursuit towards FIRE, your job is to figure out how much more you can contribute towards the goal. Let the market give you the power of compounding in the growth assets that you spoke about. Now, this is the benefit of the modern India that we live in today, that we have plenty of opportunities to participate in growth assets, both financially and non-financially. So I'm making that as a generic call, that growth is possible. Your job and my job is to accumulate as much as possible so that your FIRE is a lot more achievable. If there was no growth assets, believe me, we would not be able to make all these assumptions in the plan, because the challenge would be then when would we meet our number. So look at this 15 crores or 17 odd crores. Only 90 lakhs is coming from your contribution. A significant chunk, well over 80-90%, is come from the growth of the assets. So time is of big importance. One is to let it continue. Two is to begin early. Therefore, when you begin early and you are going to contribute well, FIRE is going to happen. So therefore, you don't have to be worried, will I ever be FIRE ready? You can be FIRE ready because of these two critical variables. One, your contributions. Two, the time you allow it to grow.
And the third aspect, which is the return, which we've assumed at 12%, just to drive home the point, the various people that have achieved a 19 to 20% compounded growth over the course of the last 4 years because they managed to invest when the COVID-19 pandemic happened, will scoff a little bit. But why don't you help them understand why this is so powerful? Because anything above that will change the target completely.
See, when you take a 12%, especially the newer investors that have come in the last 3 to 4 years, will look at it and say, why only 12%, and markets can deliver a lot more? Because the last 3 to 5 years have been particularly rewarding to the investors, and most people today are making an assumption that a 15 or 18 is very doable. We are purposely kind of toning it down, because that's also another way to be FIRE ready, that you don't be very optimistic from a long-term perspective beyond a 12% number. 12% also is optimistic. Now, why we are saying that is, when you plan for 12% and you have a target in mind, any extra 1%, 2%, 3% growth helps you be FIRE ready early. Or helps you bulk up a lot more, that even if you had a certain number, you'll kind of achieve a slightly more bigger corpus. Now remember, that 30-year period, even a 1% delta or change for the positive, like 12 becomes 13 or 13 becomes 14, will add a few crores to your savings, which is the bonus. That's exactly what the last 4-5 years investors have experienced. If you were an investor who started towards your FIRE the last 15-20 years ago, and you are nearing ending that period, you're very well rewarded. Now, we do not know market cycles. I don't know in 2045, will I have the last 3 years at 18% or 8% or 12%? Therefore, from a longer term perspective, we have sufficient data, both globally and domestically, that why something like a 12% is optimistic yet practical.
Yeah, and it's not as esoteric as certain other things that people have written about, where a butterfly wing flaps here and there's a volcano somewhere else. But you know, it's much more measurable, it's much more realistic, and it's achievable as well. But the question is that enough? You talked about how a 15 crore corpus can be built, and it's actually possible. But a lot of people will wonder, is that going to be enough for a longer period of time? So is that also something you need to bear in mind?
That's the whole concept of being FIRE ready. Is that when you're coming closer to the goal, number one, you know how much you've accumulated and how much that has grown into. I think today what we are doing is we're trying to make a hypothesis 15-year, 20-year,
Yes.
based on the inflation that you think is right.
Right.
Now you could, factor a 5% or a 7% or a 8% even, because we're a growing economy. But when you're coming closer to the target, it's the same thing of the mirror. Analogy we spoke about. You will know your actual number because
Becomes clearer.
it becomes clearer. And second thing is, you'll also know what your lifestyle entails. At a younger age, your lifestyle is more about impulse spending and consumerism. Towards the end, closer to the retirement part, maybe it's healthcare, maybe it's something else, right? So therefore, you have to factor in those specific costs. So while FIRE is a good number to work at, you have to be a little flexible, both in terms of the amount of money that you're contributing and even about the realistic expectation of how you live off it.
So it might be a good idea for you to maybe save more than just what the FIRE indicator gives you. And the more you have, the more beneficial it is.
So therefore, the 25x rule that you have for
It's just a
FIRE
thumb rule.
is just a thumb rule. The further into, greater than the 25 you are, the more safer you are. Because then you're trying to take out any ugly turn the inflation curveball may come at you. So therefore, if you are at maybe 30 times or 35 times or 40 times, now that 35, 40 times can happen because of two things. Number one, you are just prudent to save more, or you are also rewarded with growth assets, or you also got in lot of lump sum ad hoc payments to be gathered into your FIRE kitty. Classic example is there are some people who work today for startups or companies that have gone public.
So ESOPs.
So that's a one time or maybe two times in a lifetime that most people would be fortunate to participate in it. Now, at 35, if you were hit with an ESOP, you don't think, okay, I've hit that number, I'm going to retire. What you think is, I use this to kind of strengthen and shore up my FIRE account and continue to work, right? So therefore, you're double fortressing the whole thing and building a moat around your FIRE.
Yeah, and nobody's suggesting that you should retire at a certain age as soon as you hit that FIRE target. You have the option, like we've established. The last aspect is, do you change the construction of your corpus once you've hit that mark? Because one would assume that once you've gotten to that point, you want to be a little bit more conservative.
To arrive at that point, initially you begin with growth assets, and you also keep in mind that you have time to benefit from you. So therefore, don't be worried about the short-term nature of how the markets are volatile. But as you come closer to it, we once spoke about that the number, when you come closer to it, as it becomes clearer, you realign it. Similarly, even your portfolio construct. If you started off very aggressively, then towards the end, you moderate. You do not need to be aggressive, because the idea of being aggressive was to capture more growth. Now, towards the end, if you've already captured the growth, now you want to stabilize or lock in that growth. So that's why the whole portfolio construction is dependent on your actual requirement out of the FIRE principle. If you have kind of adequately met the goal with abundant provisions, then you tone down the riskiness in your portfolio. It cannot be that you hit the number, your portfolio is aggressive, then one small 6 months, 1 year market cycle depreciates the value of your investment. So
it can be anywhere between 10 to 15 to 20%.
Easy. Yeah. And remember, the 10 to 20% is not on what you saved, is on what is accumulated. And that's a big number. So what you do is, like 1 or 2 years before your goal achievement, you take a stock of things. Similarly, you even take a stock of realigning your portfolio. If you met your goals as far as the financial number is concerned, you realign the portfolio to drop the risk, include stability, and maybe start income.
Yeah. That's a good point. And I hope that everybody listening and reaches that point.
In fact, that's the interesting part of keeping your personal goals incorporated to your portfolio to keep it dynamic, because there's no two people that are same. If you got your FIRE number and you got enough longevity in you, both for a career and for your income, maybe at that time you'll make your portfolio even more aggressive, because now your FIRE is done, you're still earning money, you don't want to retire. That means you can lever up your portfolio risk even more. Essentially, it's a disposition. And by planning well, you offer yourself a choice whether I should cut risk or increase risk.
And the risk reward at that point might just be favorable for you. Santosh, thanks so much for joining in, for giving us that perspective.
Thanks, Alex. Always a pleasure talking with you.
And it's a pleasure for me as well. That brings us to the end of this edition of Money Wise. Hopefully this has gotten you thinking about your own fire moment? Let us know what you think in the comment section, and do stay tuned. Lots more coming up on NDTV Profit.